All right, so Exxon Mobil's latest quarter. On the surface, it looks fantastic, right? We're talking record production, a solid earnings beat, but the stock, it barely moved. So in this breakdown, we're going to dig into their earnings call and figure out what's really going on. What is the market seeing that we might be missing just from the headlines? So here's the game plan. First up, the numbers. We'll hit the big ones. Then we'll get into the narrative, the story behind those numbers. And to wrap it up, we'll look forward with the next call, what you should be watching for. Okay, let's start with the bottom line. Adjusted earnings per share came in at $1.88. And you know what? That's a solid beat. A full 6 cents better than what Wall Street was expecting. So right out of the gate, a pretty strong start. But then you look at the top line, and the story gets a little more complicated. Revenue was $85.3 billion. I mean, that's a massive number, no doubt. But it actually missed what analysts were looking for. And it's down about 5% from this time last year. Okay, now this number, this is where things get really interesting. Exxon hit a company record, nearly 4.8 million barrels of oil equivalent per day. That's what MMBOED means, by the way. It's a huge metric for production. And this just shows that their operational machine is absolutely firing on all cylinders. Just incredible output. So that brings us right back to the central puzzle here, doesn't it? You've got an earnings beat. You've got record-breaking output. But the stock just kind of sat there. So what gives? Why didn't Wall Street reward these results? That's exactly the mystery we're going to unpack. And the answer, really, it comes down to this classic tug of war. On one end of the rope, you have Exxon's just incredible execution. And on the other end, you have these powerful macroeconomic headwinds pulling against them. It's the story of a really well-run company navigating a very, very tough environment. And you can see those two forces laid out pretty clearly here. In the operational strength corner, you've got record production pumping out of the Permian and Guyana. They're being super disciplined with their capital spending, just fantastic stuff. But then look at the other side, the macro headwinds. Brent crude prices are down 13% year over year. That creates a weaker pricing environment, and that hits the bottom line. It's why free cash flow was softer at $6.3 billion. You know, this quote from CEO Darren Woods really gets to the heart of how they think. He says the industry has to bring on more barrels just to stand still. Think about that. It's like running on a treadmill. You have to keep investing and producing just to overcome the natural decline of existing oil fields. It's a long-term game for them, and they're not getting distracted by day-to-day price swings. And look, this isn't just talk. The details of their execution are, well, they're super impressive. Their massive Yellowtail project in Guyana, it started up 4 months ahead of schedule. That's huge. 8 of their 10 big global projects for 2025 are already up and running. And get this, they're using their own special tech in the Permian that's improving well recoveries by up to 20%. That's what world-class execution actually looks like. All right, so that's the story of the past quarter. But as investors, we're always looking forward, right? So what's next? Let's dive into the guidance for management and see where they're pointing for future growth. When it comes to how they spend their money, management has a really clear playbook. It's a 3-step framework. First, disciplined capital spending. They're actually trending below the low end of their own target range, which shows serious control. Second, growing that dividend. They just raised it again, making it 43 straight years of increases. And third, share repurchases. That huge $20 billion annual program is right on track. So, on the earnings call, some analysts kind of pushed back on that 4% dividend hike. They called it pedestrian. But management had a great answer. They basically said, look, we prioritize a dividend that's durable, one that can survive the ups and downs of the commodity cycle. They'd rather give a steady, reliable increase than some big, flashy one they might have to cut later. It's all about durability over drama. And here's what's really cool. While they are absolutely crushing it in their core oil and gas business, they're also making some big moves for the future, looking beyond the barrel. They're getting into synthetic graphite for EV batteries, which is a direct play to compete with China. They built a new supercomputer, one of the world's most powerful, that's cutting down their seismic processing time from months to just weeks. And they're even working on carbon capture to provide low-emission power for all those power-hungry data centers. These are some serious long-term bets. Okay, so we've looked at the numbers, we've unpacked the narrative, now it's time to put it all together. This is the next call, where we give you our rating and our take on what happens from here. So this is the big question, isn't it? After a quarter like that, amazing execution, but a meh reaction from the market, Where does the stock actually go from here? So our call on this is market perform. Now, what does that mean? We think the stock is likely to perform right in line with the broader market. And it's because of that tug of war we talked about. The company's incredible performance is pulling one way, but the macro uncertainty is pulling just as hard the other way. They're basically locked in a stalemate for now. So let's break that down a little more. For price action, we see it as range-bound. That amazing operational strength provides a really solid floor. It's hard to see the stock falling off a cliff. But at the same time, all that macro uncertainty is going to cap the upside. Production should stay nice and strong, probably between 4.8 and 4.9 million barrels a day. And the one thing you really want to watch for, circle December 9th on your calendar. That's their big corporate plan update. It's going to set the whole story for 2026. Okay, so with that market perform rating in mind, what's the actual trade? How could you play this? Well, one potential idea here is to sell out of the money puts. Now, let's not get lost in the weeds of option strategy, but here's the simple version. It's a way to collect a little bit of income by betting that the stock won't drop below a certain price. See, you're not betting it's going to the moon. You're simply betting that all that fantastic operational execution we've been talking about provides a really firm floor for the stock price. It's a bet on limited downside. And of course, we have to say it. This is for informational purposes only. It is not financial advice. Please always do your own research before making any investment decisions.